Central state relations. Financial relations. Financial relations. Article 268 to 293 of the Constitution deals with center-state financial relations. Allocation of taxing power. Taxation of the subjects on the Union list is the sole responsibility of Parliament. Taxation on the things included in the state list may only be done by the state legislature. The items on the concurrent list are subject to taxation by both the state and the Union. The residuary power to tax belongs to the Parliament. The constitutional restriction on the state's taxation power. The power to tax occupations, trades, callings, and professions belongs to the state legislature. However, no one should receive more than 2,500 rupees in total compensation each year. Taxes on the sale or purchase of products can be imposed by a state, other than a newspaper. However, the following factors restrict the state's capacity to impose a sales tax. Sales and purchases made outside of the states are exempt from taxation. Sales or purchases done during the import or export process are exempt from taxation. No tax may be levied on a transaction or purchase made during interstate trade or commerce. A tax imposed on goods sold or bought that the Parliament has determined are of particular importance to interstate trade and commerce is subject to the limitations and specifications set forth by the Parliament. Electricity used by or sold to the centre, as well as electricity used in the building, upkeep, or operation of any railway by or sold to the railway company for the same purpose, are exempt from state taxes. A state may charge a price for the water or electricity it sells to an interstate river authority that Parliament established to manage and develop the river. On the other hand, a law that receives the approval of the President may enact such an imposition. Distribution of tax revenues. Taxes are levied by the centre, but they are collected and used by the state. Article 268. The state's consolidated fund receives the proceeds from this and holds them there. For instance, excise tax and stamp duty. Article 269. One illustration would be taxes imposed on goods purchased or sold in interstate commerce. The state's consolidated fund receives the proceeds from this and holds them there. Although the federal government imposes and collects taxes, they are divided between the federal government and the states. Article 270. His category includes all taxes, with the exception of the ones mentioned above, surcharges, and cess. Based on the Finance Commission's recommendations, the President determines how these taxes are divided. The tax and levies surcharges mentioned in Articles 269 and 270 may be enacted at any time by Parliament. Proceeds from the surcharge are only used for the centre. State-imposed gathered, and held-back taxes consist of. These are the taxes that fall under the purview of the states only. They are listed on the state list. Agriculture income taxes, alcohol excise taxes, profession-specific taxes, ceilings, etc. Distribution of non-tax revenues. The center's primary non-tax revenue sources are as follows. Postal and telegraph services, railroads, banking, broadcasting, coinage and currency, central public sector enterprise, escheat and lapse. The main sources of non-tax revenue for states are as follows. Irrigation, forests, fisheries, state public sector enterprise, escheat and lapse. Grants in aid to the states. State grants in aid are permitted by the Constitution to come from the federal government. The two types of grants in aid are statutory grants and discretionary grants. Statutory grants. The Parliament is empowered by Article 275 of the Constitution to provide grants to states that specifically require them rather than to all states. These amounts may vary for various states. These funds are levied annually to the Consolidated Fund of India. Depending on the Finance Commission's recommendations, these are given to the states. ISCRETIONARY grants. Article 282 gives both the federal government and the states the authority to provide grants for any public purpose, even if it is not within their purview. The choice is entirely up to the center, which is under no obligation to offer these subsidies. Other grants. A one-time donation for a particular cause was permitted by the Constitution. For the states of Assam, Bihar, Odisha, and West Bengal, grants on jute and jute products could be used in place of export taxes. These funds were to be given out for 10 years starting at the time the Constitution was adopted, per the recommendation of the Finance Commission. Goods and Services Tax Council. The smooth and efficient administration of the Goods and Services Tax, GST, requires cooperation and coordination between the center and the states. In order to facilitate this consultation process, the 101st Amendment Act of 2016 provided for the establishment of a Goods and Services Tax Council or the GST Council. Article 279A empowered the President to constitute a GST Council. The Council is a joint forum of the Center and the states. It is required to make recommendations to the Center and the states on the following matters. The taxes, cesses and surcharges levied by the Center, the states and the local bodies would get merged into GST. The goods and services that may be subjected to GST are exempted from GST. Model GST laws, principles of levy, apportionment of GST levied on supplies in the course of interstate trade or commerce and the principles that govern the place of supply. The threshold limit of turnover below which goods and services may be exempted from GST. The rates include floor rates with bands of GST. Any special rate or rates for a specified period to raise additional resources during any natural calamity or disaster. Thank you.